Let's say two people each contribute an equal amount to buy a house together. If one of them passes away, their 50% share will automatically transfer to the surviving co-owner without going through probate. This avoids complex inheritance procedures and saves time and legal costs. Real estate co-ownership. Which form should you choose? Today, I'll walk you through two common but often misunderstood ownership types: joint tenancy and tenancy in common. We'll break it down with real-life examples so you can confidently choose the right one for your situation. Let's start with a common scenario. You and a close friend decide to buy a house together as an investment, and both contribute the same amount. So how should the ownership be recorded? As joint tenancy or tenancy in common? Both sound similar. They share the word tenancy, but how they actually work is very different. From how the shares are divided, to how you can sell the property later, and most importantly, what happens when one of you passes away, the legal and financial outcomes can vary significantly. First is joint tenancy. What is joint tenancy? Benefits and risks. Joint tenancy means equal ownership among all parties. Most importantly, it includes the right of survivorship. If one owner dies, their share automatically transfers to the surviving co-owner, avoiding probate. This is ideal for spouses or close family members. Let's say you and a loved one buy a house and each own 50%. If one of you passes away, the entire property transfers to the surviving owner without court involvement. Another benefit of joint tenancy is related to taxes. When one co-owner passes away, their portion of the property is reassessed to the current market value. This is called a step-up in basis, and it can significantly reduce capital gains tax. What does step-up in basis mean? Let's say person A and person B buy a house together for $500,000. After 10 years, the property appreciates and is now worth $800,000. In a typical case, if they sell the house, the $300,000 gain would be subject to capital gains tax, often between 20% and 30%. Let's assume a 25% tax rate. 25% of $300,000 equals $75,000 in taxes. But with joint tenancy, if person A passes away, their 50% share gets a step-up in basis to the current value, $400,000, which is 50% of $800,000. Person B's 50% share keeps the original basis of $250,000, half of the $500,000 purchase price. So now the new combined basis is $400,000, A's adjusted basis, plus $250,000, B's original basis, equals $650,000. If person B now sells the house for $800,000, the taxable gain is only $150,000 instead of the full $300,000. At a 25% tax rate, that's about $37,000 in taxes, a savings of $38,000 compared to the $75,000 they would have paid without the step-up in basis. However, there are limitations. Ownership must be equal, such as 50-50 or 33.3% each. You can't leave your share to heirs in a will. Selling your share requires consent from all co-owners. So, while joint tenancy offers simplicity and tax advantages, it's not suitable if you want unequal shares or to pass your share to someone outside the ownership group, so that we have tenancy in common. What is tenancy in common? Key things to know. Tenancy in common gives more flexibility. Owners can hold unequal shares, for example 70% and 30% or 55%, 33% and 12%. Each person owns a specific percentage based on contribution. You can pass your share to anyone via a will or trust. Each owner can sell or transfer their share without needing approval from the others. This makes it great for investors or friends pooling money, but it comes with legal risks. If someone dies without a will, their share goes through probate, delaying any sale. A co-owner can sell to a stranger unless you have an agreement in place. So, legal clarity is crucial before you buy under this arrangement. Now let's do a quick recap to compare these two forms of co-ownership. Joint tenancy versus tenancy in common. Which is the right choice? First, both joint tenancy and tenancy in common are available when two or more people co-own a property. But the ownership structure is different. With joint tenancy, ownership must be split equally, like 50-50 or 33% each. With tenancy in common, you can divide ownership however you want, 30/70ths, 60/40ths, 55/45ths, it's totally flexible. Next, when one co-owner passes away, in joint tenancy, their share automatically transfers to the surviving owner, no court process needed. In tenancy in common, that share does not transfer automatically. It must go through a will or the probate court. So, can you leave your share to someone in a will? Not with joint tenancy. It bypasses your will and goes straight to the surviving co-owner. But with tenancy in common, yes, you can absolutely include your share in a will and pass it on to your heirs. What about selling your share? Joint tenancy requires consent from all other co-owners if you want to sell your share. But with tenancy in common, you can freely sell or transfer your share without asking for anyone's permission, unless there's a separate legal agreement in place. And when it comes to avoiding probate, joint tenancy helps you avoid the court process because of the automatic transfer. Tenancy in common doesn't offer that benefit. If there's no will, the property gets held up in probate, which can delay any sale or transfer. So in conclusion, each ownership type has its own pros and cons. If you want equal ownership and automatic inheritance, joint tenancy might be the better fit. But if you want flexible ownership shares and the ability to leave your portion to your heirs, then tenancy in common is the way to go. Also, keep in mind, these aren't your only options. There are other ways to hold title too, like LLCs, corporations, sole ownership, or living trusts. I will make videos on all of these, so feel free to check them out to find the best option for your situation. Choosing the wrong type of ownership can be costly, both in time and taxes. It can even cause legal disputes later on. So before you make a decision, be sure to talk to an attorney or real estate professional. Each state in the US has different rules, so do your research and get advice specific to your location. If you found this video helpful, don't forget to leave a comment below and share it with friends who are exploring real estate. Hit that like button and subscribe so you won't miss the next video. Thank you so much for watching.
Real estate and mortgage broker Danguard, with experience in over 1,000 loan applications and real estate transactions, aims to provide you with useful and general knowledge about this field. For advice on each specific case, please contact via email or website provided below the video. Don't forget to click like and subscribe to the channel to stay updated with the latest information from Danguard.